As the trading week commences, global financial markets are gripped by a palpable sense of anticipation and caution. Stock futures are ticking lower, signaling investor apprehension ahead of a barrage of critical economic reports that promise to dictate market sentiment and potentially influence the Federal Reserve's monetary policy trajectory. The focal points of this high-stakes week are the much-anticipated jobs report and key inflation data, which together are expected to provide crucial insights into the health of the U.S. economy. The week of February 9th to 13th, 2026 is being widely described by financial analysts as brutal and a market bombshell. Traders are keenly focused on two primary U.S. economic releases, the Non-Farm Payrolls (NFP) report, delayed but now scheduled for Wednesday, February 11th, and the Consumer Price Index (CPI) report, due on Friday, February 13th. These figures are not just numbers. They are seen as pivotal catalysts that could trigger significant market volatility across forex, indices, metals, and energy markets. Initial expectations for the NFP report suggest a gain of approximately 70,000 new jobs and a steady unemployment rate of 4.4%. However, recent data has painted a mixed picture of the labor market. January 2026 saw over 108,000 job cuts, the highest start-of-year figure since the 2008 to 2009 financial crisis, indicating potential cracks despite a historically low unemployment rate. Some analysts are questioning the true strength of the labor market, noting a decline in job openings and a rise in part-time work. The impact of AI on employment figures is also a topic of discussion, with some speculating it could influence the accuracy of the upcoming jobs report. On the inflation front, the CPI report for January 2026 is projected to show inflation easing to 2.5%. This follows a period where inflation remained stubbornly high, with the Consumer Price Index advancing 0.4% in March of the previous year, extrapolating to 4.4% annually, well above the Fed's 2% target. A continued decline in inflation would strengthen the case for potential interest rate cuts by the Federal Reserve later in the year. Conversely, hotter-than-expected inflation could delay such cuts, as the Fed has maintained a cautious stance, emphasizing the need for sustained decline in inflation before adjusting rates. Some indicators, such as triflation, even show the U.S. CPI inflation rate falling to a new yearly low of 0.63%, leading to speculation about whether the Fed is already behind the curve on rate cuts. Beyond these critical macroeconomic indicators, the week is also packed with corporate earnings reports. A flurry of companies, including major players like Coca-Cola, Spotify, Ford, Cisco, McDonald's, Shopify, Hermes, Applied Materials, Coinbase, and Pinterest, are scheduled to release their quarterly figures. These earnings announcements will provide further insights into corporate health and consumer spending patterns, adding another layer of complexity and potential volatility to the markets.